Symposium. We're pleased to welcome now Charles White. He's the Managing Director of Fixed Income Capital Markets at Stifel Financial Corp. Charles, always good to see you. Thanks for coming on.
Yeah, thank you. Glad to be back here. Hope you've been well.
Yeah, have been. A little car trouble on the way up, but we're here. We're good to go. Everything's settled in. So this is a great event, isn't it, Charles?
It is, and it's actually almost 400 people here now.
That's
today,
amazing.
Which is unbelievable.
Yeah.
That you take an industry like banking that, there are only 15 banking majors in the entire United States, this being one of them. It appears to be, maybe a dwindling industry in terms of interest, designing, CPUs seems to be more attractive to people. But each year this thing has grown.
Yeah.
And we get really good discussion. We've got a lot of technology-heavy topics here today because technology is about to change banking. So it's a lot of fun, number one, and we see a lot of old friends and a lot of new people. There's probably 100 people here who've never been here before.
Okay. Wow.
Yeah.
That's awesome. All right, so give us your take on the macro economy. I always like to say that economists have to have two arms, two hands, because it's always, this is what I think is going to happen, but on the other hand, this could happen.
I'll just put one behind my back. How's that sound?
I love it. And of course, a lot of people are plugged in to the various political parties that they align with, and the descriptions they give of economic conditions, there's like a Grand Canyon chasm between what they describe. What's your insight? What are your folks saying?
That was actually a topic of our discussion here just a few minutes ago with one of our Washington, D.C. guys at my company, and there has not been since I've been paying attention to this since the 1980s, really 81, 82, and we have never seen a chasm of opinion on where we are as an economy between the two sides, political or otherwise. But I think the rock-solid truth is this. Number one, the top third and the middle third by earnings in the United States are doing quite well.
Yeah.
Both Wells Fargo and B of A, who run a decent slice of the U.S. economy through their balance sheets every day.
Sure.
Credit cards, checking accounts, you name it. They'll tell you that spending is continuing to stay strong. The bottom third, though, is lagging. You've seen some of the initial effects of that with the blow-ups in subprime auto and things of that nature. Now they were probably rushed forward a little bit, when immigration stopped and the demand for subprime auto slowed. But bottom line is the bottom third, their wage growth is not keeping up with inflation.
Right.
However, they're a small slice of the economy, smaller than their numbers. And so overall, we don't know, right? We're walking across a dark room trying not to bump into the furniture. We don't know what the economy is doing because the government reporting mechanism has been shut down.
Yeah.
It'll get lit back up here soon. We're probably looking at, if you believe the Atlanta Fed, somewhere north of 3% growth this quarter. Now, I also think that some of the beneficial effects of the BBB Act are going to be loaded into the first quarter of next year. So I got to tell you, I think two things are very clear. One is the economy is going to continue to grow.
Okay.
Ignore the stuff you see on social media about, oh, my gosh, credit card delinquencies are highest since they've been in 2008, right? Well, credit is the lowest it's been in 2008, credit standards. So that's not to be unexpected. But I do think that the economy is going to continue to grow fairly quickly, 2 to 3% this quarter, next quarter.
So I did a little research on the 3.8% figure for GDP growth annualized posted for the last quarter.
Yep.
And so it came across some data that indicated if we removed all the investment driven by AI, especially all the infrastructure investment, it's 0.1%.
Okay.
So now that's I guess kind of a hypothetical situation because you can't discount the fact that that's a major part of our economy now. But it seems like that's where the super high growth is coming from.
Well, if you eliminate the auto industry, it's probably negative, right?
So, I agree, but I think...
How about closing bars? Maybe it'll be a little more.
I think it's a good news situation.
I think it is.
Because I think this is a revolution that's occurring. This is a transformational revolution that's occurring. And I think what gets missed out of that is all these initial investments to create all this foundation, all this infrastructure is benefiting those companies directly involved in that. We hadn't gotten to the part as much as we will where the other companies that consume that technology will benefit.
Exactly. I mean, granted, these are numbers that are shocking, truly shocking, when they tell you Meta is going to build a data center outside of Monroe, Louisiana that's half the size of Manhattan. So these numbers, make you suspicious because they're so large. But you're right. The first guy that gets employed, operates a track hoe, right? The next guy drives a cement truck. The next guy drives or makes the CPUs, that go into the data center.
Yeah.
And then, after that, perhaps those kind of tail off. But the increase in productivity caused by the usage of that technology gives you another boost. So I think it's a true statistic, right, that is icing on the cake, and the cake itself is a little smaller than you'd hope. But at the end of the day, that has recurring effects that are positive.
It's the only way, I preach this on the show all the time, the only way to create more wealth is to be more productive. When we produce more per hour of labor and man hour of output, that's how we get rich. I mean, that's how we create wealth.
Well, and to use a phrase that has gone out of fashion, your standard of living rises.
Sure.
Right? I mean, that's what everybody wants.
Why don't we use that anymore?
Well, I don't know. I mean, the people who elected Zoran Mondani, that's what they want.
That's exactly
just like you and I.
They just want to take it from one group and give it to another and skim off the top.
They're past the point of caring how they get it, right? They just want it.
That's right.
But you're right. And that productivity through the use of, think about an Excel spreadsheet. My son works in private equity now, and he is an Excel spreadsheet genius. And you think about what we did, because Excel spreadsheets came about in our lifetime.
That's right.
What did we do before? He can take an entire business, break it down into that spreadsheet, and run you a 10-year projection in a matter of hours. And that's not using AI. That's using, a spreadsheet. So those kind of things are going to continue to happen, and they're very beneficial for the economy as a whole.
No doubt about it. And that's why we've got to keep boosting this innovation economy. Yep. And I think it's a renaissance on us, honestly.
Totally. Now, we'll get a bubble, right?
Sure.
We may already have it.
Sure.
It'll get popped.
Yep.
May already be happening. Unfortunately, that pop bubble splashes soap on everybody, right? And some a lot more than others, and so you wash it off and move on. But think about it this way. Who was it? Cisco. Cisco stock just got back to the high of 1999 or 2000.
That's right.
Right? Well, the right thing to do was let the bubble pop by Cisco, and then the real long-term wealth is created. And that's going to happen here, too.
Driven by AI.
Exactly.
Being incorporated into more traditional network infrastructure.
Totally, because it is a game changer. It's one of the subjects here for banking, because if you take banks today, a great deal of their expense goes to employing people to conform to regulations. And AI will help make that a lot better. Now, before everybody starts lamenting the jobs that are lost, think about, I'm on the board of Bank Plus. Our total assets are almost $8 billion. We could go to $10 billion without an additional person with that kind of productivity.
Yeah.
So that's where I think the benefit is.
I agree. That's real wealth creation.
Totally.
That's
totally.
what that is.
Our shareholders are better off. Our employees
Customers
are better
off. Everybody's better off.
We're more efficient.
Yeah.
We can pay more for deposits, charge less for loans, all that.
Yeah.
And at the end of the day, I think that's where we're headed, which is
awesome.
Very beneficial.
That's awesome. Well, you have any thoughts about, just ask Gordon about this, the 50-year mortgage that's being floated out there? Any particular ideas, thoughts?
Well, number one, it's obvious everybody's focused on the monthly payment.
Yeah, exactly.
Right?
Exactly.
And at the end of the day, you've seen the analysis. If 50-year mortgage versus a 30-year mortgage, you end up paying the mortgage holder quite a bit more money, right? So it's a long-term wealth drain.
Yeah.
It's a gimmick that doesn't help. And the market's probably going to have to charge a higher rate because that mortgage is going to have a longer duration.
Gotcha.
Right? So that's not a fix. The issue with housing, well, the main issue is the Fed stimulated way too long. They kept the mortgage rate artificially low after inflation was over 6%. All three of my kids got 3% mortgages. Yeah. I'm very thankful
for it. Both of mine got 2 and change.
Okay. Yep. Yours are smarter than mine.
Yeah, well, it's about a 2-day window, I think, in there, Better
to be lucky than smart.
Exactly right.
But bottom line is There's a couple of ways to really solve this. One that keeps getting mentioned that I hope gets traction is to exempt capital gains on your house from taxation. You know, you get a $500,000 one-timer. Most people who have big gains probably hit that one-timer. But you do that, you unleash the supply.
Yeah, a lot of squatters.
Yes. Or another idea, which I hope they can do this. I think this would be great, but it's going to cause a lot of heartburn for some people, is make them portable. Take all your Fannie Mae and Freddie Mac mortgages and make them portable. Now, that's going to really cause a lot of whatevers.
Getting some traction the last few days.
It would help the housing costs.
Charles, when I was buying a house during the early 80s when it was 10, 11%, 12% mortgages, you looked for that assumable mortgage.
Totally.
To get a 7% mortgage, you thought you would hit the jackpot, right?
And so those things I think would help. My first mortgage was 10 5/8.
Yeah.
But the house price wasn't that big.
That's right. The combination of those two doesn't work.
No.
Appreciate it.
And lower rates doesn't fix it.
I get it. Charles White, Managing Director, Fixed Income Capital Markets at Stifel. Appreciate it, Charles.
All right.
Thanks, man.
Thank you. Good to see you again.
Coming right back. The Element Wealth Studio in Oxford.